All right, welcome to followmetrades.com earnings strategy kickoff webinar for Q2 2020, and we're recording this on Monday, April 13th. And so in this session, I'm going to be talking about the earnings strategy that we've been using here at followmetrades.com. We launched it 2 quarters ago. We've been getting some good results, and as we go, we've refined it. We've learned a little bit. And so for existing subscribers, I want to go over some new guidelines. And then for visitors who are interested in this strategy, you'll kind of see what the current process and strategy and guidelines are. So that's really what we plan to do. Again, make it interactive. I'll answer questions on the fly. This session really is for your benefit. Let me introduce Mark, who is working with me on this strategy. If you just want to say hello, Mark, real quick.
Good morning, afternoon, wherever you happen to be.
All right. And so, kind of the story, I was going to introduce myself too. I was going to turn my camera on for just a moment here. So, hey, I'm Dean Jenkins, founder of followmetrades.com. There's really somebody here behind the microphone. And again, glad to have you here, but I'll turn that off so it is not a distraction for you. Okay. So again, we're going to talk about the earnings strategy and again, changes to it. So let's get right into that. All right. So let me get the right presentation up for you. And first, as always, we're going to look at some example trades. Right. All trading involves risk. I'm not a financial advisor. I'm not giving financial advice. I share what I'm doing. Each person makes their own decision. And of course, all trading and investing involves risk. So, the whole premise of trading earnings, for many years, I was swing trading and running my stock picking service, trading my own account. I just avoided earnings because it was disruptive. And you got, a couple things going on. You got some information coming out that you don't know what it's going to be. And there's going to be a reaction in the market. You don't know what that's going to be. Right? So I just avoided it, and we did well with swing trading. But in the back of my mind, I was always thinking, man, there must be a way to capitalize on these moves, because you see that, when earnings are announced, quite often there's a big move. It'd be nice to be on the right side of that. And so I began working on an earnings strategy, and in my trading room, I'd mention it, give an update once in a while. And about last summer, I've been talking about an earnings strategy for going on a year, and just had been working on it. I hadn't refined it, just didn't really have the time to go deep into it. And one of my customers in the trading room, Mark, sent me a note, and he goes, "Hey, I heard you mention the earnings thing. I've been working on that too. Would you like to compare notes?" I said, "Yeah." And so we did. We had a chat, and it turned out, Mark was working on something very similar, the same kind of principles that I was looking at. And it turned out that Mark is a really smart guy, a good trader, and he's a really skilled developer. So he was able to bring some tools to the party to help bring in massive amounts of data and automate that. And that's what we really needed to finalize and back test and optimize our earnings trade. So it was really a good partnership. And we launched, our very first, we tested this thing. We said, hey, this looks good. He and I started trading it with our own money. We got good results. And then we launched it at the end of last October, opened it up to customers. And then we did it for the last quarter of last year, first quarter of this year. And both Mark and I continue to get good results, and the folks who have been subscribed are getting good results as well, profit. And again, we've learned as we went along, so we have refined it. But here, here's the premise of the whole thing, right? And this is earnings announcements can present opportunities in trading. An earnings beat or a miss can cause a big move in the underlying stock. And pending results can cause an expectation of a large move. And that's typically expressed in changes in the option implied volatility. Now, our approach to trading options or trading earnings isn't options only. We think options are the way to trade it. There's not much of a case to be made for trying to trade shares through earnings. And part of the reason is it's harder to limit risk with shares. Okay, you can gap through a stop, and with options, you can control that through your position size. It's a little harder with shares. Okay, but there are opportunities in earnings, and it comes when a big move is expected or predicted, but it's not fully priced into the options yet. And so, you know, if everybody thinks Tesla is going to have a big beat or a big miss, or Apple, or pick your company, quite often that is fully priced into the options. And so even if you were right, and you know, Apple's expected to make a $10 move up or down, and you were to go buy a call or a put based on that move, quite often that's already just priced in. And even if you get the move, you're going to break even. But occasionally there will be it won't be priced in, and then there's an opportunity, and that's where it takes, you know, some pretty sophisticated data mining and analysis and algorithms to go identify those opportunities. That's what we do. Sometimes there's a clear directional bias up or down, and you're able to just go long or short, you know, using puts or calls. And the cool thing about that is every trade that I take and Mark and I are in lockstep on this, it's got to have a high reward to risk ratio. You got to be able to make more if you're right than you would lose if you're wrong. And you're going to be wrong on earnings about half the time. But we're taking things that have a 3, 4 to 5 to 1 reward to risk ratio. So, you know, if you're at 50% and say your average loser, the most it's going to, or the losers, the most a loser is going to lose is $500, right? But your winners are going to win 500, 1,000, 2,000, 3,000, 4,000, and they have, right? If you can maintain that, right, at a 50% win rate, you're profitable. And that's exactly what's been happening. Okay. So you can have a directional bias. You can have a big move that's expected, but it's already priced in, and you can still participate with some strategies, which include buying and selling, like butterflies and condors. And, you know, or if it's going to stay within a known range, you have those strategies. So we have a handful of option strategies that we apply. And I've got a list of them. Right. Let me show you the strategy. So here are kind of the lineup of option strategies that we use, depending on the setup and, you know, just all the parameters that we look at for an earnings trade. But we can take a straddle, which means you're just taking a call or put at the money on both sides. A strangle, where you're a little bit in the money on both sides. And this really has to do with the price of the options and the strike increments. It's easier if the strike increments are $1, right, to get closer to at the money. If there are $5 strikes on a $70 stock, sometimes you got to go in the money on either side. What we want to do is balance capital. If we don't have a directional bias, you know, say we're going to put $200 on either side of the trade, you want to find that balance in your option pricing. What you don't want to do is be neutral on direction and put $500 on one side and 200 on the other, and then be out of balance. And of course, it's going to move toward the $200 side. You'll get a move and you still lose money. Strip is a bullish a bearish bias where you're not sure. So you take, you know, half your position on the call side, half on the put side. And if you're right, you're going to make money. If you're wrong, it's going to soften and lower the loss. And then strap's just the opposite of that. It's bullish. Long gut straddle strangles are kind of similar to that. We can do iron condors, regular reverse, where we don't think there's going to be a move. Double diagonals, and then butterflies, where we think it's going to move within a given range. And sometimes we employ those on higher cost. You know, if you're going to trade Apple or something like that, you know, taking at the money puts and calls is going to be a, you know, $2,000, $3,000, $4,000 position. And, you know, we model everything based on a $50,000 account so that more people can participate. So we're looking for about a $500 max trade. You know, people with bigger accounts can just scale that up. But with a butterfly, you can go trade something like Apple because of you're doing, you know, 2 buys and a sell. The sell helps offset the cost. Okay, so that's just a quick look. And then there's also something we do called an IV rise, an implied volatility rise, and that's a trade that we're taking into earnings. We're not going to hold through it. So if we got a company that's got a clear trend going into their earnings announcement, and there's, you know, we use a set of indicators to forecast and have a probability that it's going to continue in that direction, up or down. What we can do is take a position about a week or 2 weeks out, try to catch that trend, and we get, if we go buy right at the money, a call or a put, we get the price of the stock moving into the money on the contract, so you make profit that way, and you get an IV rise. There's a predictable kind of a sawtooth pattern where when we go into earnings, implied volatility, particularly on the shorter term contracts, is going to rise sharply. And then after the announcement, it's going to drop off a cliff. It's a little sawtooth, right? You can watch it coming into earnings, Price goes up, then it drops. So we can catch that rise, and we get the multiplication of rising price, increasing delta, and increasing IV. And we've done really well on some of those trades. So that's an additional strategy that we employ. So here's some things we learned over the last couple quarters as we rolled this out and offered it to subscribers. And the first is, this wasn't really a learning, this is a restatement, something we do up front, that, risk management just has to be respected. Excuse me. And it's got to be incorporated, right? Earnings are volatile. The win rate's about 50%. So you've got to keep those losers small, right? And so the first question on every trade is, how much could I lose? And you have to be able to answer that. And that answer, to make this work, has to be, it's never more than 2% of your trading account. Ideally, it's about 1%. The reward to risk must be on our side, right? We got to have the ability to make more money if the trade wins than we will lose if it fails, right? Because we're going to win about half the time, which is okay because we got to edge in the reward to risk. So we're looking for things not just greater than 1-to-1. We're looking, most trades have a 3, 4, 5 or higher. And some of our breakouts, have been like 10-to-1 in reality. It's been great. Okay. Our favorite is straddle strangle if we don't have a directional bias. They work best when we, at the peak of earnings season, when, 1,000 companies a day are reporting, and we filter through for, open interest, liquidity, a bunch of other stuff to make sure we're trading legitimate companies. But even then we'll have, 200, 300, 400 candidates. And that's great because we can just go take the cream off the top of that, right? On the leading edge up, and on the trailing edge at the end, you get fewer and fewer candidates. And, we learned in our first quarter, just because, you got a great candidate out of 10, it may not be a great candidate, right? So, take fewer trades and be really, really picky about them is the learning there. And then we added some buy and sell strategies like butterflies, condors. And that really helps when we have a directional bias, and we can reduce cost and reduce risk. So that's really cool. Managing open trades during earnings is an art. In my standard swing trading service, I provide black and white detailed, step-by-step guidance on every trade: entry, exit, profit, scale in, scale out, close the trade. On earnings, we can't do that. It happens too fast. And so to be successful as a trader following this service, you have to be, you have to understand options. You have to understand how to place orders. And you have to be able to manage your position and be comfortable with that, because it's going to happen fast. And each person's going to have their own spin on that. Okay. So, we give some guidelines on management of them. We have a trading room during earnings season, for a half hour right at the market open. And we look at what's happening. And, hey, Mark says, this is what I'm doing. I'll say, this is what I'm doing. Traders will chime in with what they're doing. And we offer some guidelines, and I'll go through those. But ultimately, you're going to have to manage the positions on your own, okay, with some broad guidelines or with your own guidelines, okay? But you got a community that's going to be sharing tips, tricks, and what they're doing via the trading room. But we can't provide detailed black and white, step-by-step exit signals. You're going to have to be able to do that because it's just too fast. And by the time I got an alert out, the price would have moved, and it would just be frustrating for you and overwhelming for me to try and keep up with. So it's better just to provide guidelines, a room to discuss the trades, and then, the expectation as you manage those trades. All right. So the earnings trader, what's needed to succeed? You need option approval at your broker to be able to buy and sell options. The different brokers label that differently. Some call it level 2, some call it level 3. A few people ask me, what if I can only buy, calls and puts? You can still participate, but there will be some trades, that you won't be able to get into. So probably I'd say 75% of trades, you'll be fine with just being able to buy calls and puts. But the other 25% are going to be, butterfly, condor type stuff. We need to be able to take a short position as well. You need the ability and availability to manage these during a regular trading session. This is not, put in your orders and walk away and forget about it. These are dynamic, fast moving trades, and you need to be on top of them. You need the willingness, and I call it the DNA level of acceptance of risk management. You just got to have, just got to be there for every trade, because these things can move, and our trade setups are designed so if it goes completely the wrong way, the loss is absolutely limited. We've set the entry size at about $500, and on a straddle or strangle or strip or strap or something, if it goes totally wrong, the most you're going to lose $500 with long option positions. Nobody wants to lose $500, but when the other ones are making $2,000, $3,000, $4,000, that's okay. If you take on too big a position size and you just go, oh man, we're going to go trade Fastenal, it's going to do this, and you go bet the farm, right? You might lose it, and that would not be good. And then we publish pricing guidelines, and we typically publish the trade candidates about an hour before the market close. And the idea is we take the trades, go enter the positions during that final hour of the session, because quite often leading up to earnings, price is going to move quite a bit. So we want to try and get as close to the closing price as possible, and then have the event happen, if they're going to announce after the close or before the open the next session, and capitalize on that move from near the closing price. So we publish a price, go, hey, both sides of this straddle, right? Don't pay any more than $375 for the whole thing. And, that's based on the expected move and all the stuff. If you go, no, I really like it, I'm going to go in for double that, it's not going to work, right? So you need to succeed, right? You need the option approval. You need to understand. You got to be available to manage the trades. You got to accept risk management. You got to be willing to pass on a trade. If we published it and price ran away and it's too expensive, just walk away. Don't take it, right? You're guaranteed to fail. If you ignore risk management, if you take entries outside the price guidelines, if you expect or need step-by-step, black and white, do this, do that after you're in a position, you're not going to get, we can't provide it, right? And if you lose track of positions, you get assigned on shorter, or you end up with naked short positions. That's not good, okay? So those are just kind of the things that we think you need to be successful, and the folks who are doing that are, okay? I do have a document when you sign through every single one of those trade types. What is a straddle? What's a strangle? What's a strip, strap, butterfly? So we got a description and a P&L chart for every single one. I'm not going to go through them here. Okay. I did have a couple other points on this other PowerPoint that I wanted to cover. Let me make sure I get to the right point for you. Here you go. So here's what it looks like when we publish a trade. I'm going to actually show you the website where this is posted in just a minute. But again, we publish a trade, we put it on the website, we send an email and go, hey, it's updated, it's ready. And then we want to take the trades during that last hour, most of the time. We'll post them, and it's going to look something like this. We're going to go, here's the symbol, right? What's the trade type? What's the call contract? What's the put contract? And then what's the price to pay for both sides, right? And then when the earnings announcement's going to be. It's important to place these trades as multi-leg orders. So this is a strangle, so we would go put the order on at the same time for the call and the put to make sure we get the combined price, right? We use a limit order, right, to get the combined price. If you buy them one by one, they could be moving and you could end up being outside this price guideline, okay? And again, if the price exceeds this total max price and the limit's not filled, just let it go. Just don't take the trade. Sometimes it happens, right? Getting in at or below the max total price is essential for the strategy to work. Paying above it can result in a failed trade. Okay, so trade management and exit rules, once you're in, right, we can't give detailed, you could write a 1,000-page book on every nuanced scenario or situation, and you'd never be able to read it or look it up or follow it anyway, right? But so we provide some guidelines for the bulk of the scenarios that are going to be encountered once you're in a trade, right? And again, we discuss all the trades in a earnings trading room Monday through Thursday, half an hour. Okay, But in all scenarios, it's important, ignore the post and pre-market action. You can only trade options during the regular session. And quite often, if the announcement for a stock is after the close, there's going to be a bunch of gyrations in price, right after the close or even before the open. Kind of ignore it because you can't trade on it anyway. And what really matters is what happens after the open and what's happening with the option pricing. Okay, so just ignore it's quite often a head fake. And, Mark can chime in. I don't know how many times during the last couple of quarters, he and I have, we're taking a trade on something and it reports after the close and we go, OMG, we got a runner. And then the next day it's like, nope, it was a dud, right?
Yep, flattens out.
Yeah, so it's best just to ignore. I mean, realistically, you're not going to ignore it. You're going to go look at it, but don't act on it. Only act on regular market session price. You can't help but look, right? We can't cover.
And we get fortunate every now and then, like with Grub, where the CEO says something really stupid in the conference call, and it went down, and it goes down more, and it stays down. So sometimes you can pay attention to it.
Yeah, but don't go buy your airline tickets to Jamaica based on the pre-market action. Okay, or don't quit your job just yet. Okay, we can't cover all possible scenarios. We've tried to capture the major ones that would give some guidelines for you. And the Trading Room is a great resource. We review the trades that we're in at the open, we offer commentary, we explain what we're going to do, and the room participants contribute their ideas as well. All right, overriding principles. Okay, this is an observation that post-earnings price, so company makes an announcement, they go down, right? The highest probability, I would say like 75%, is it's going to continue in that same direction for a while. That's the typical move. There's no guarantees, there's no free lunch on Wall Street, no certainties. But I would say 75% of the time, if it goes down during a regular session after the announcement, it's probably going to continue down about 75%. Okay, so we got to be patient and let those runs run. Right, and that gets into we have some some strategies for that we're going to cover here. Taking positions that typically have about 3 weeks to expiration, like right now we're in mid-April. We'll be looking, if we're taking straddle staggers, we'll be looking at the May expiration contracts. You got time. Then we pushed out. All right. Let me catch up on the questions. Mahmood, say at the height of the season, how many trades are you in at the same time? We're limiting the number we publish each day to about 4 or 5 during the peak of the season. But some of those, like the point I made, you got at least a winning side of a trade, or you got what we call a scrap heap, right? So you may have, as Connor said, 10 to 15 different positions open. But typically you've closed one side of those and now you're just managing the other side, okay? Helber, no, we are not always closing the day after. We're gonna let some of these run, okay? We will take profit right away on part of the position and then we'll let the rest of it run, okay? So I think I'm caught up on the question. So you gotta be patient, let them run. So take profit when you have it. And we like taking partial. So say you got, you got a low price thing and you got 3 calls on one side, 3 puts on the other side, right? The thing pops, they announce before the market opens and the stock jumps 15%. Well, guess what? Your puts are worth 0, which is okay. And your calls are going to be worth a lot of money, way more than what the whole thing cost. That's awesome. So what we do on the calls, we'll sell one, right? Lock in a little profit. And then based on this phenomena that most of the time it runs, we're going to put a trailing stop on the run with it. And then when it does reverse, close the position. Okay. Yeah, we call them rocket ships. Okay. So it's important to lock in some profit, but to leave the position there for more. So these nearly worthless, so in that example, we had a straddle, right? We had equal number of contracts and equal amount of capital in puts and calls. The thing gapped 15% on the results. So the puts are worth 0. They're going to be worth a nickel a piece and you paid $1.50. Okay. keep them. It's going to cost you more than a nickel a contract. So hold them to expiration, because this phenomena of the follow through direction is good for 3, 4, 5 days. It may reverse after that and come back, and you can get, if they're trading a nickel, you can get them sell them for a quarter before expiration, or sometimes it totally reverses and you get out of break even. You can make profit on both sides of the trade. So don't sell a worthless contract. Just hold it. If it expires, it expires. It's not going to lose any more. So that's a learning and a kind of a guideline. And then when we do, butterflies and condors, they're direct. Butterflies are directional. You're going to go buy calls, and you're going to, have 3 strikes if you're familiar with how a butterfly works, right? And the middle one you're going to sell, which lowers the cost of the position. So if it goes the wrong way, we bought some butterflies. It was a call, and the thing went down. Well, the good news there is your short position is probably going to be worth pennies. Maybe you got paid, $200 for the contract, and now it's worth $5. Go buy it back, right? And then wait for the rest of them to reverse and see if they come back into profit. But if you get an opportunity to buy back your shorts for pennies, take it, right? And then just hold and wait and see what happens. And then if it does go your way, watch your strikes. Don't ever get assigned on your short positions. If you need to buy them back, for me anyway, I'll buy them back before it'll hit before it goes in the money and I have a chance of being assigned. And you need to understand these terms if you're going to play this. Right? If you're going, what's he talking about? It may not be a good fit for you. Okay. What's the next?
And
So
just
here,
to touch on what Sean was asking before on that, we never have so we don't sell anything. We don't have anything that's ever naked. So we are always covered on both sides so that we know what our maximum risk is. So when you say, are we selling a straddle or strangle? Never. We would never sell a naked straddle or strangle. It would be an iron condor or something that protects us on either side of the trade so that we know what the defined risk is.
Yes, and thanks for jumping in with that, Mark. Mark and I both believe, so you will never see us take a spread, just a straight vertical spread, because they have a terrible reward to risk ratio. All of our trades have 2 things. Every single time without fail, our trades will have these 2 attributes. There will be a black and white well-defined risk. How much could you lose? And it will always be an acceptable amount if you follow our guidelines. And the second thing is we'll always have a positive reward to risk ratio, meaning it has the potential to make more money if it wins than it could lose if it fails. Okay. It is virtually impossible to construct a credit spread trade with those attributes. Virtually impossible. So I listed 6 different scenarios here, and this is available in a PDF. But people that subscribe, it's posted into the secure area of the website where customers have access. I'm not going to walk through these. They follow these overriding principles. We've just outlined 6 different scenarios, right, that you can kind of get some guidelines. And again, we have a room where we review these trades each morning, Monday through Thursday. So let me show you the kind of the website and what it looks like for a customer, when you sign up. So there's my website. You log in. It's my test account here. So we got the earnings trades, and you go, here's its trade details. And so these documents, right, there's an overview of the different trade types I told you, where it goes into detail about a description of the different plays, the straddles, strangles, strips, straps, all that stuff with P&L graphs. And then the guidelines with all those scenarios laid out. These are PDFs you can download and study. We embed a spreadsheet where we post the trades, right? And we always put a date stamp on it. So we took a trade on Friday, and this was simply a index volatility play. So we just took a strap, a downward bias on the, this is a bullish bias on the S&P 500 3X inverse. Right? We said it looked like from Thursday's close to the Monday open, we expected a down move. And guess what? S&P 500 is down nearly 2%. The Dow is down. We can round that to 500 bucks. We made money on that trade. And so that's not really an earnings trade, but I'm firmly in the camp that you should absolutely meet all the, fulfill all the promises you make, but it's okay to deliver a little extra. And since we didn't have any earnings last week, because earnings season was kind of flattened out and we're getting ready to kick off, why not put out something of value for the subscribers? So we did this, and that was a winner. Okay, so that's the trades are posted, and we have another I talked about the IV Rise, so we will post them on a separate little sheet here. These ones are traded before the earnings. We hold them, a week to 2 weeks. A little bit different animal, but we post those here. And then I'm going to update this with, I'll put the recording here of today's webinar. And then what about results? So under here, we always keep the results updated, within a week or two. This is a lot of work. But we keep a running summary since we've launched this service of every single week, right? How did the weeks do? And you can see not every week is a winner, right? But if in Q4 of last year, on a $50,000 account, we made 10 grand. That's 20% increase in the account. Q1, we made 44, call it 4,500 bucks. And you go, wow, that was like half. Why? Well, we had one really bad week, and that was the week of February 27th, 20. Does anybody remember what was happening at about that time frame? I can remind you. What happened on that week? Get to the S&P 500, good look at it. Remember this, right? That week was right about here, right? The market blew up. The market blew up, right? And that was a anomaly, right? And we're trying to price options based on IV and all kinds of stuff, and our model just got totally thrown off. So, but even with an outlier week where we lost, 3,200 bucks, we still had a profitable quarter. And if that had been flat, right, if we hadn't had this as a dramatic outlier, this would have been very similar. We would have been sitting here at about 8 or 9 grand. It would have been very, very similar to Q4. But it did happen, and we were still very profitable, right? Making 4,500 bucks on a $50,000 account in a quarter. That's about a 10% return. So even if that's the best we do, I don't think anybody would criticize that too much. Mahmood says the S&P got Corona, right? Okay, so I'm gonna have Mark share for a minute. And Mark, this is what we show our earnings traders in the morning, and Mark's going to share a spreadsheet of all these algorithms and data feeds and stuff that he has put together and that we have agreed on that we use to identify trade candidates.
And I will apologize if I break up a little bit. I am sitting in my office and we are having a little internet issue here. So if you hear a little robot, that's the case.
Yeah, the whole internet's just under unprecedented strain. I've noticed a lot of things are slow.
So this is the spreadsheet, and these are actually the companies reporting after the close of this evening or before the open tomorrow. And they are listed this might actually be today. Is it 14th? So the 14th. So these are the before the opens tomorrow and after the close. So I'm gonna have to adjust that. But we will typically, on the spreadsheet, when we show it the morning of when we do the call, we will have the after closes for that day, and the before opens for the next day will be the ones that we look at. This is typically a live feed. I was having some issues with my Thinkorswim, so that's why you see that one line has a value in it. The Thinkorswim is not loading correctly. That has to do with the internet issue I'm having right now. But we take a look at what is the percent of the contract that we're looking at. That's you see the percent of contract column. You can see some of them are 44%, the second one in there. is 44% of the price of the stock. It's a $4.52 stock, and the options would cost you $2. That's something that we stay away from. We're looking for something that has a price advantage to us when we get into the options. And on this particular spreadsheet, it's not updated. This was my last time I looked at it because I'm having the internet thing going on. But at the time, J&J and JP Morgan were things that fell kind of within our parameters. And then we'd look at the type of trade. Dean and I would get together. We'd look at it. I'd give here's what the data is telling me. He puts his chart skills to work. We look at it. We see if we can come up with a trade that makes sense for the earnings that we would publish.
And so again, these are the real companies reporting tonight after the close or tomorrow before the open. And so current or new subscribers may get some trades if at the end of the session, by 3 p.m. Eastern, if the parameters make sense, if we have a price advantage. And we're looking, Mark mentioned JPM and J&J. We were also looking at Fastenal. If there's a trade there, we're going to publish it. If they're sketchy, we're not going to, go, hey, we would rather publish 0 trades than just throw out some dogs and have people lose money. But we may get a trade in that.
And you'll hear us say quite often that sometimes the best trade is no trade.
Because the whole thing works is if we have a pricing advantage, right? And if you get a, say Pac W there, that's Kenworth, right? Isn't it?
I don't know what that is. No, it's actually a bank. It's Pacific West Bank, I believe.
So say Pac W, there's a high probability of a 15% move in the stock on earnings, right? But you go look and say that's what is this? What's the price on this underlying 20? I don't know.
$20, somewhere around that.
Okay. So, say it's going to make a $5 move, right? Which is extreme, right? But you got to go pay $7.50 for it. That's not a good deal. Even if it does it, you're going to lose money, right? So you got to look for that price edge. And that's what this whole massive infrastructure and data feed and algorithms are identifying for us.
And then we're also, in the final column here, you're seeing these are all the ones. I haven't filtered anything out, but we're also looking at open interest. So there's got to be a market. There's got to be liquidity for us to be able to get in and out of the trade. If you look at something like this top one where you got 0 at this strike, you got 0 calls open and 11 puts, that would be something that you would shy away from. But we would look at the entire matrix of what trades, how many options are in that particular expiration to see if there's, as long as there's several hundred or several thousand open contracts on that company, that's something that we would look at.
Yeah. Okay. So that really is the presentation. That's what we wanted to cover today. We're certainly happy to field any questions that people have. So if you're not a subscriber and you tuned in and you're like, well, I'm intrigued, I'd like to give that a shot. Let me put a link into the chat box for you. And you can sign up now and get the trades today, if any ultimately qualify. We got about 3 that might. Just fair warning, they may move and not look good, and we won't take them. The saying among airline pilots or airplane pilots that we love is, I'd rather be on the ground wishing I was in the sky than to be in the sky wishing I was on the ground. And Ray, yeah, this is a separate product from the stock option picks, the swing trades, and the regular live trading room. So this is earnings. It's got a separate access on the website, separate trading room. And hopefully you see that link if you're interested in signing up. And I'll send out a link to this recording. Take an hour or 2. But if you wait for the recording and the email and all that, you will have missed today's trading opportunities probably. So if you want to get in, you probably want to hit that link. And here's where it goes. This goes to an order page. Oops. Messed up my cutting and pasting. that link that I just posted in the chat box to this order form in Infusionsoft, and you sign up. 97 bucks a month. So again, you know, we did 20% in Q4. We did 10% in Q1. Can't guarantee anything, but I think we got about how many?
Well, I think the big thing too is that we have skin in the game. We're taking the trades that we're putting out there, so we're right there with you.
Every single trade Mark and I take with our own money. And I was looking at this, Mark. Can you believe it? For Q4 and Q1, we've taken 460 trades.
Oh.
It's sometimes 4 or 5 a day at the peak, but you don't have that perspective until it's back. Wow, that was a lot of trades, man. Yeah, for those who are, if you're psychologically suited for something like this, the folks that are doing it are having fun, right? They enjoy it. It's a little bit more adrenaline than my swing trades. Some people tried it and go, whoa, that was a little crazy, and it's okay, and they backed out. But I think we got 40, 50 people who have been in this from the start and really enjoying it. If anybody is a current subscriber and you got any comments to offer the rest of the folks, go ahead and type it into the chat box. Make sure you have it set to panelists and attendees. And Sean, there really aren't any alerts. All we do is we say, hey, the trades are posted by 3 p.m. Eastern, and we'll send an email and go, hey, they're up, or maybe they're up a little bit early. We don't send alerts and go, get out of the trade, do this. Like I said, there's no signals. There's just an entry, and then you manage it by yourself.
And everybody comes up with their own. I mean, I work full time, so I do have kind of my own way to manage my trades with trailing stops and things like that to look at it. We have our earnings call in the morning. We go through it. We may make some trades live right in that room saying, okay, we're going to take the profit, or we're going to sell this or do something. But I got to go to the office. So I say, okay, this guy's the winner. I'm going to take a 50-cent loss on it, or let it go down 50 cents, and I'm going to sell it at a profit. So everybody's got their own way of dealing with it. But I make sure that I've kind of got things dialed in before I jump in the car and head to the office.
And Sean's asking, yeah, you got to log in. And Bill said, yeah, Bill is just making the point. You got to be familiar with options, and you got to be available. And I put that on a slide, and it's a true statement. And Florian, it's a fair question. Said he's still learning and coming up to speed on the swing trades. And if you're still coming up the learning curve on those slower, simpler trades, you may want to hold off. This may just frustrate you, and particularly if you're trading a live account, you can make a mistake and lose money, and you don't want to do that. So, I'd love to have your business, but I'd hate to see you make a mistake and take a hit. And Ray, how soon will the presentation be available? It just depends on, Zoom is incredibly busy. They went from 10 million users to 200 million in the blink of an eye. And so this recording has to get rendered on Zoom servers, and they're busy. So I don't know is the answer. As soon as it's ready, I'll get it posted. But by 3 p.m. Eastern, Mark and I will have reviewed the trade candidates, and we will have trade candidates posted tonight. That's not dependent on anything other than some people are saying TOS has had issues all day. As long as TOS is working, which provides the data feed for Mark, we'll get it going. Oh, thanks, Terry. There's a nice recommendation there from Terry. You got to be a little patient. I showed you in the, you got to be a mature enough trader to recognize that not every trade wins, and not every week is a winner, right? There were some red weeks. except for that one exception when the when the market caught the coronavirus, right? The losing weeks were tolerable, and we ended up with some big winning weeks, right? And that's what makes the whole thing profitable and fun. You got to be mature enough as a trader to not go, well, I took a trade and it lost, so this thing doesn't work. Half of them are going to lose.
And the other critical piece is what you had said earlier on the individual trades is making sure you're balanced on both sides of the trade. But the whole thing works too if you're balanced in your approach to every trade. Meaning if you're going to risk $500, you risk $500 on every trade. Trying to pick this one and say, oh, I think this is going to be the winner, and tripling up on that one, and then that one becomes a loser, really blows your your performance.
Yeah. Oh, nice. So Bill, another nice testimonial there. Thank you. Well, we're getting a little dead air, so I'm going to stop the recording at this point.